Looks like we have a couple folks watching. So maybe for all our viewers out there, thanks so much for joining. I think we're going to wait a couple more minutes just to see give everyone who's kind of joining us from here, there, and everywhere a chance to join up as well. And then Mark will talk a little bit more about Hamilton Court, and we'll just dive right in. So for folks who are viewing, just a couple minutes, and we'll get started probably at 5 past. And folks, for all of you who have joined us as well, if you notice there's a Q&A feature, you should feel free to drop in your questions both during the webinar, but also, now if you have them, if you have a burning question that you really want to share with the world. So, we're going to get started in about 2 minutes. So if you just want to fill that out now or later, it's totally up to you. Mark will be happy to answer whatever he can. So work away. Don't be shy. So Mark, how about you flip your camera on and maybe just introduce yourself to the folks who have joined us, and maybe we'll get going.
Sure. Hi. Good morning, afternoon, evening, depending on where you are. I'm Mark Palmer. I'm the Chief Operating Officer of Hamilton Court. Hamilton Court is a specialist FX brokerage. We work with businesses across the UK, Europe, and further afield to mitigate currency risk for commercial purposes. So we don't concentrate on speculation. We concentrate on managing risks and trying to avoid as many pitfalls as you can do in the foreign exchange markets. And we work with companies that go from startup to, in the UK, FTSE 250. We do a lot in the AIM market. Canada will deal on the TSX. So a very broad base of company size and also the industries that our clients work in. Our expertise is, again, in the foreign exchange area, and what our clients do is their business. Our specialty is entirely the FX side. So what I wanted to do today is just sort of spend a few minutes running through, I guess, where we see risks in high growth areas, and maybe put a couple of pointers out there as to where we should maybe direct you so you can. Sorry, something just popped up on my screen. Lovely. Sorry, maybe where we can direct you so you maybe better prepared, or at least have some sort of conversation, some thinking points. So I'm going to start a screen share now, and hopefully everyone can see what's going on with this. So here we go. So I think high growth, normal growth, average growth, it's all fairly similar. I guess when you're in a high growth environment, though, you have a lot of considerations that come along at once, from working out what your market is to all of a sudden, being in demand, and then having to manage that on top of everything else that comes, with being a small business, and going through that growth phase. From statistically, I thought it worth putting some data up, just very brief. This is from the UK looking out. So on the left-hand side, you'll see that the UK, export out to the continent, and also imports in, is largely a growing business. Exports to China are slowing down. That's probably, due to their general softening in growth itself. But on the whole, you would say that business is expanding across different sectors as well. So certainly, these aren't problems that are going to go away anytime soon. And you're going to find FX is certainly more prevalent, whichever market you're dealing in. This is an interesting slide. This is looking from a US dollar perspective as to how well and how poorly currencies have performed in the year to date against the US dollar. And those are percentage swings. So if you thought about that as profit margin, there's certainly some great wins, but probably more interestingly on the right-hand side, there's some real sort of potential losses that, poor currency management can make. There'd be plenty of people that would love to be dealing in even single-digit margins, and that's easily eroded, without careful preparation. Also of note on there as well, I mean, that is what we would call a major FX pair. So all these currencies are majors against the US dollar. So there's plenty of business happening in these areas in the world. So even if you can't imagine doing business in Colombia or maybe New Zealand, there are plenty of your peers that will be. And with the way that the world is working, most people are moving towards emerging markets to try and find new growth areas and places where perhaps there's less competition and possibly more opportunity. So with those statistics in mind, I guess we wanted to highlight just a few potential problems that we see, and this is by no an exhaustive list. You can read them for yourself. I guess the first one to think about is your forecasting. If you're in a business that's gone from zero to flat out in a very short space of time, then perhaps you don't know what the next year or the next 6 months will be like. But to have an idea of a forecast is certainly a starting point. So let's just jump straight to how we're going to manage this. So imagine we're doing business, it's going well, but you're forecasting 100% year-on-year growth. The caveat to that is that your existing business is being generated from one major client, and you're looking to expand and diversify that. So if you're fixing the price of your goods with that client 12 months, you're probably going to want to fix your own cost prices as well. But certainly this is what a lot of our clients are seeing now, that diversifying their supply chain away from perhaps Asia and to places that are closer to home allows them first mover advantage. But obviously in diversifying presents its own set of problems with managing relationships, building relationships, and also migrating from one supplier to another. So this scenario really, if we think about it in simple terms, if we thought about it being you're importing a product from the Far East, you're in a European or UK market, we want to mitigate any foreign exchange risk on the purchases, but also be flexible in the amount of currency that we're obliged to purchase. So the traditional route to hedging would very much be a vanilla, so a very simple foreign exchange forward. A forward rate is based on, or is a currency purchase for a specific amount at a specific date in the future. Very little flexibility, but ultimately an awful lot of certainty in that you have an obligation to sell a certain currency. In this instance, we've used £1 million to keep the numbers round. But you know that at a date in the future, you've got £1 million to sell, and you're going to get the dollars for that. It becomes, if you've got diversification in supply chain, you can't break that contract without the cost to you. And also, if you bought too much or bought too little, then you're either going to have to sell some back, or you're going to have to buy some more. Those potentially cause you problems because though your price on the forward exchange contract doesn't move, the price in the market does. So we'd possibly look at some slightly more flexible structures to enable you to, I guess, work towards your forecasting, allow yourself to be well hedged on what you think your requirement is going to be. But even if that requirement doesn't fully materialize, or you do want to diversify your supply chain, you're in a position to move away from that contract, reduce the obligation on you, and therefore look to other areas of the market to be able to satisfy your demand. And the way we would approach this would be with a simple participating forward. So without wanting to get too technical, this ultimately gives you protection for your £1 million at your hedge rate. What it also does is if the market moves in your favor, so following the blue line, you would get participation on 50% of the amount as the market moves in your favor. So this is really an extra additional margin grabber for you. If the price of sterling versus the dollar rises and all of a sudden you're buying your goods at a 5 cent more favorable rate, then that goes straight to your bottom line. So this gives you some flexibility to be able to participate in that. I think more importantly, especially when you look at high growth businesses, is that we could have a hedge here for £1 million, but if you don't reach your growth targets, then you're actually only obliged to purchase £500,000 worth of dollars. So you've got effectively 50% flexibility on 100% certainty, which I guess is pretty key to the whole high growth strategy of wanting to be optimistic and wanting to be prepared for that growth, but understanding that even with the best laid plans, there are peaks and troughs in every industry and every business. This is an interesting one. So I don't think many people do enough analysis on the markets they want to go into. I've actually used an example here from a client we've been speaking to for the last 3 months, who's setting up shop in Russia. They've got taken local offices. They want to deal with local clients. They're a European-based, Central European-based company, but they're just assuming that everything that they want to do will be fine. And if they go in, they're going to be invoicing their customers in Russian rubles. They're going to be receiving Russian rubles, and they'll get them back to euros eventually. The problem with that is, the moves in the market there over the past year have been sort of plus and minus almost 50%. Now, anyone that's working on an operating profit of above 50% would probably be, inclined to want to absorb those, but the reality is not many people do. So I think even though you can assume that you can go and do business in just about anywhere in the world, and a regulatory, there's no reason why you wouldn't be able to in most instances. The realities of managing a foreign exchange risk in an emerging market are very, very different. So, we'll take the Russian ruble example there. They don't use the same banking network that the UK do, and the rest of the world indeed. So there's no guarantee you can get funds out of Russia. Their interest rates are an awful lot higher than they are just about anywhere else in the world, and actually they're a constantly changing thing. So if you're looking to hedge the income that you're expecting, is that going to be too expensive an exercise for you to want to achieve? And also, as we well know with Russia, there are evolving sanctions and cans and can-nots of business, which lead to enhanced due diligence, increased costs in terms of managing the FX flows, and I guess putting into place plans and strategies that may not be able to come to fruition because of the changing picture and landscape out there. And quite simply, all of this could be avoided by just dealing in euros. So even though you may have done as much homework as you can to get to the point that you want to play in the local market, you want to compete with the local players in that market, you might be shooting yourself in the foot, where it might be better just to step off and just to say, actually, we're going to do as much as we can, but we are going to insist on a currency that is tradable to be paid in, and therefore hand the risk over to your client. And there's no harm in doing that, potentially, but as long as you've explored the possibilities and the realities of doing business out there, then at least you can make an informed decision. I guess this is the main thing. You've got plenty of resources. As a growing business, you're going to have someone standing behind you, and as I've said, their experience is often as useful as their money to you. These generally seasoned investors with a team behind them, and if they haven't seen a situation before, you can be pretty sure that they've got someone in their network that has. So having open conversations as early in the game as you can certainly gives you a leg up. Your bank now, banks in many ways are our competition, but we use them as well. We've got 30 plus banking lines, and they are a wealth of information. So there is plenty of information, and there's plenty of assistance to be found in a bank, and they can answer a lot of questions, and you can tap into their expertise. The one thing I'd say is that your relationship manager has an awful lot on his plate or her plate, and is never going to be in a position to give you all the answers. So use that caution, but be mindful, obviously, that they are certainly your go-to route for the financial markets. And failing that, brokers are specialists in what they do. their skill set isn't broad. It's very narrow, but it's very deep. Whether that be insurance, mortgages, loans, financing, or certainly in our world, foreign exchange. We are a wealth of information on a very specific subject. We can tell you solutions, we can show you solutions, we can work with you to create working solutions. And I think often for a lot of people, they don't realise that our access to the markets is as good or greater than a bank's, but it does come with the added benefit of pure professionalism on the back of it, and a very deep and granular understanding of the market that we work in. So I'd always say, if you haven't got a broker, find one. They work along banks just well. Don't have too many. You don't need to take advice from 15, 20 people. You just need to find the one or two people that you can trust and work with. And that's about it. On the first slide, I said that one size fits nobody. It is very, very true. So unfortunately, that is the case for a lot of businesses. If it was all off the shelf, this would be a very easy process to go through, and it would just be a case of picking up a product and working with it. No two businesses are truly alike, and therefore you really do want to, I guess, find a more bespoke solution. And that doesn't need to take too much time and effort, but it does need to be a considered approach rather than just treating FX as a commodity to purchase. And I think I probably raced through that a little bit quicker than I was intending to. So there we go to Q&A. Connor, I don't know if you've got the Q&A questions up, if there are any, but I'll bring that away from the screen and back to me now. So if there are any questions that people want answered, or anything that crops up following that rather swift presentation, then please do feel free to type, talk, or otherwise.
All right, can everyone, I think you can hear me now. I was having a technical moment there for a second. Thank you so much for that. That was great. I think what would be wonderful now, so first for anybody watching, we have a Q&A app enabled in the Google Hangout. So if you want to just drop your questions in, they'll show up, and Mark will be able to field them. So that could be really helpful. But then I definitely have a few questions that I'd love to talk about. So I'm going to just get it started. First up, Mark, what are sort of the big stumbling blocks you would face if you're, for example, a team based out of China who wants to work, in the U.S. or work with currency-based, work between the USD and the yuan? I'm thinking specifically about the news this week about, or was it late last week, China devaluing its currency. How do you accommodate sort of those political things if you're like a pretty lean startup?
Sure. I think the move that they've made in the last week to devalue the yuan is quite difficult to manage after the event, but looking forward, you would definitely think that there's no reason that something that's been done before couldn't be done again. And therefore, you do need to think about perhaps the revenue streams that you are going to be receiving, and what that looks like to you, whether you want to lock in, effectively the additional profit that you've been given. If you're selling dollars further down the line to buy yuan, you would want to make sure that what you're doing is probably locking in some of that profit, but giving yourself an opportunity for upside. And whether you're lean or not is almost irrespective, because the simple products that I showed you there are fairly open within the market. So I'd say, first of all, forecast your revenues. Secondly, look at the forecast returns based on the exchange rate as it was, the exchange rate as it is now, and then decide if you want to lock in that upside. And if you make a decision to lock in that upside, then go and have a conversation about it.
Cool. And I think we have a question from Des Byrne, who I think is here in Ireland, and he's just wondering, what's your view on the US dollar versus the euro for 2015? And I might also say, like, what's coming up on the horizon for that? I know, as someone who works back and forth between the US and Ireland, the currency exchange it's been killing me, but it's also been something that's definitely on our radar. What's going to happen with that? I'm also thinking of what's the role of Greece and all of that. There's so much going on. What do you see coming down the pike?
Sure. I mean, well, Greece seems to be a slowly developing solution, or finding a slowly developing solution, but actually it's a very small part of European GDP. With the efforts that the central bank have put in, you would expect probably over the course of the back end of 2015 and into 2016 for the growth dynamics to improve in Europe, and hopefully that in turn improves the prospect for foreign direct investment. And if people are investing into Europe, then theoretically the currency does strengthen. I think in the exchange rate specifics, we found a fairly strong floor at the 105 level on euro dollar. It's now well clear of that, and 110 seems to be offering some temporary support as well. So I'd be looking really to say, probably to finish the year and put my neck on the line here, finishing the year between 108 and 112, within range of where we are now. And then for 2016, probably to see a push back up to 120s, with the caveat that there always is a strong floor at 105, and that I've got a crystal ball. There's probably a bigger caveat there.
Right. And how does sterling play into all of that? Is there any sort of relationship between what happens on the USD euro rate?
Yeah, absolutely. I mean, if you take sterling at the moment is just almost entirely shadowing. Sorry, as we'll come through. Sterling at the moment is almost entirely shadowing the interest rate move in the States, which is why we're seeing very little movement in that. Once we see liftoff from the Federal Reserve in terms of raising rates, we'll probably see the UK closely behind. So sterling euro rate will be driven more by the euro dollar rate. So as we see Europe's prospects improve, that will probably significantly strengthen the euro versus sterling, probably to a greater degree than it would do strengthen the euro versus the dollar.
Mm-hmm.
So again, forecasts are capped at the top side at 145 if you deal in sterling euro, but we could see the euro strengthen and pull the pound right the way down to 130, 135 level.
Oh wow, cool, crazy. All right, we have a team in London. One of the questions is, hi Mark, my startup is based in London, but our main market is in the US. Our main costs are in production in China and in salaries in the UK. Where should I keep the money, and how should I change USD into GBP and into RMB? Thanks.
I mean, that could be a 1 minute answer, that could be a 10-minute answer, but I'll try and keep to the former. If you've got dollar RMB costs, they were fairly well pegged up until last week. So you could manage the flows between the US and China very, very simply. Going back into sterling in terms of costs, you can toss a coin as to where sterling dollar is going to be. But I would say if you work yourself on a budget rate of 150 and try and lock in towards that, you'd be doing well. The interest rate differential between the two currencies is negligible, so you can hedge forward for a fair amount of time as well at minimal cost. And then at least you've got control of those flows. So if anything does happen, the Fed raise rates next week, and then the UK decides not to raise for a year, then you've got control of the situation entirely, and it's not going to hurt you if the currency moves down to 140. So I think you've got stability throughout, then great. And then as the business grows and your cost base increases, then you can always add to the hedges that you've got. But at least you've got a stake in the ground and work out, I've got a rate of 150, I'm happy with that. Let's see where it goes. And if the market goes to 170, how am I going to react? And where does that bring my average overall price? And if you're trading over the course of the year, you will be, it's the most important thing is probably to be able to look back and see where you traded it as an average over the year, because there are always going to be highs and lows in the market. But if you take out the peaks and the troughs, that's what you're going to see a year-end account, you're going to see an average price.
Great. Hope that's an answer.
I don't know if that answered it or not, to be perfectly frank. I'm hoping it did. I'd love to have a conversation offline. If we want to go into some more depth and actually run through cash flow specifics, I'm more than happy to.
Sure. And again, I just invite anyone who has questions, just drop them into the Q&A feature. You'll be able to relay them on. Another question I have just in the interim is about cryptocurrencies. That was a big thing back in 2013, 2014. what role does cryptocurrency play in the work you do? Is that something that people should was that just a trend that's kind of over? Is that something that people should still be thinking about? Is that just like the kind of the techno-libertarian dream gone awry? What's the story there?
I think with most things, it's consumer driven. If there's a demand, it will be filled by someone. I think probably the Federal Reserve are actually quite naive to think that it won't play a part in the future. And I'm pretty sure if you look back and looked at PayPal, Amazon, and the Googles and the Apples of this world, you'd say, well, that'll never work. People stick with reading books and doing sums on a calculator. And the reality is very, very different. So cryptocurrencies, yes, you need to find some kind of definitive standard for that, whether that's Bitcoin or something else, and then just see where it evolves thereafter. But I think all the while, governments are trying to improve or increase the regulation around their currencies. There's probably going to be a kickback against that as well. So, I'm not a buyer yet, or not a buy and hold, but I can't see why they wouldn't be. 5-10 years down the line, us having a portfolio of cryptocurrencies.
Great, that's interesting. What are some of the things that, what are kind of small, almost hacks that teams that are lightweight, that are lean, that might be kind of cash strapped? What are some of the kind of easy things that they might not know about or might not be aware of to kind of have the most advantageous rate, or kind of be the smartest about where they keep their money, how they move it between currencies between countries? What are some of what's your top 5 list of things that people either don't know about, unaware of, that kind of benefit small businesses?
So I think the first and foremost, currency is market. They are competitive. So whether you're using your bank because you've always used your bank and never looked outside of it, I think the foremost thing to do is to go to a broker, another bank, and say, what are you offering me? You see rates of exchange vary massively, from people getting charged 0.25% by their bank up to 6% on sensible numbers as well, on hundreds of thousands and high hundreds of thousands. So that's money directly lost by the business. So that is certainly rule 1. Second, I think is probably, a lot of brokers and traders are guilty of this, is not to overthink, the minutiae of, I'm going to save £5 here if I trade and I wait and I hold on to this currency because you have a rate in mind. You've got to, if you need a currency to operate in, you need to go and buy that currency. And as long as you're buying from someone that's giving you value and not making too much profit for themselves, then go and get it done, because your business is your focus. The currency market should be, but it shouldn't be your sole focus. I think thirdly, people talk to me about investing in high yielding currencies. You go and buy Indian rupee, you get 10% in the current account in terms of interest. But then what happens if that currency depreciates by 12%? You've lost it. So I think don't speculate with what you do. Play the conservative game, make the margin from your business from the products and services that you sell, and just be mindful that the only currency pairs you should be dealing with are the ones that you have a direct exposure to in your business. I think that's probably only 3 of the top 5, but if I think of the other ones, I'll put them on the Q&A.
No, that's great. It's good. It's good food for thought. What kind of experience do you have with startups? What work have you done maybe with kind of emerging companies that are working? I suppose most of your experience might be with EU companies or UK companies who are kind of working with the European market. What are some of the pitfalls you see for teams based in places like London or Ireland or Germany when they try to expand into the US, for example, or maybe into China on the other end of things? What are what are regular issues that you see coming up again and again, especially if you're a smaller business or a startup?
Sure. We can empathize with the US. The biggest problem we found in going out to New York was regulation. It's a huge market, but you've really got to work hard to sort of kick down the door. I think pitfalls, and certainly this was for us, was just overconfidence that because we've got a product and an offering and we know what we're doing in the UK, it doesn't directly translate to that market. We didn't go it alone in the end. We've got boots on the ground out there. We've got a JV. And we've got experienced market participants in that market working with us. And when we go out to Asia as well, we intend to do exactly the same thing. There's no substitute for local knowledge, really, and it's finding that trusted partner. I don't think that covers too much on an FX side, because from the foreign exchange impact of your business, that can all be very well controlled centrally. And what we do with startups and early stage businesses is work with the business, but also the investor, to make sure that the approach to foreign exchange is sensible and probably dealt with in a more sophisticated way than just a small independent company would normally look at. So we're using our expertise and the expertise that the investor expects to plug straight into that company, so they're hitting the ground running with FX, rather than going in, all guns blazing, and then realizing that they've got an FX exposure that they should have been managing from day one, and they're now 6 months down the line, and profits have been eroded.
Got it. Okay, cool. We had a question from Ben Doyle, who's just finished up actually IndieBio, which is one of our biotech accelerators. It's in Cork. And so his question is just, hey Mark, my startup is based in Ireland, but our initial target market is Honduras and Central America, Limpiras, I guess. Any advice on how to best approach these economies and the kind of economies of developing countries in general? That seems like a question with lots of potential answers.
Yeah, I think that the main one is, if you can deal with the US dollar, you might as well. I think that the majority of the businesses out there are trying to also keep their costs and expenditures in US dollars, because it's much more stable than a local currency. Even something as established as the Mexican peso is going to be a lot more volatile and a lot more difficult to control. So I think first and foremost, work out what the appetite is for dealing in US dollars. And that also gives you the advantage of being able to work through a number of territories, but effectively having a euro cost base and a dollar revenue stream, rather than a euro cost base and 5, 6, 7 emerging market currencies that all behave probably in a similar manner against the euro, but all have certain nuances and individual quirks that are going to take up an awful lot more of your time.
Yeah, and so in general, just kind of, it sounds like the answer is to lean on the dollar as much as you can, especially in Central America. What if that's not an option? Are there ways to protect yourself? Yeah, absolutely. A lot of it, in fact, being in Ireland and close to London, London has a tremendously advanced financial centre able to deal with some very sort of esoteric territories and manage risk effectively. The problem and the biggest thing that you'll have in trying to manage FX risk with an emerging market currency is that invariably their interest rates are a lot higher. So if you're selling out of a high yield currency to buy into a lower yield currency, i.e. the euro, that in itself becomes an expensive exercise. So if they've got a 5% interest rate and Europe's at 0, then over the year you're paying 5% for the privilege of mitigating your risk. So again, that's why if you can take it a step back to the US dollar or the euro, I mean, there are plenty of countries that are looking to diversify away from the US dollar. And you'll find that the euros are, in certain instances, an attractive proposition for them to be able to balance their hedging and exposure as well. Right, and if you're an Irish entity, then that makes plenty of sense, because absolutely, there's no need for someone like me in your life, so it keeps things very simple. Great. And then, I don't know, I'm not sure how pertinent this question will be, but one thing I'm thinking a lot about is that when you're a startup negotiating your kind of rounds of investment, if you are working with an investor outside of whatever home country or home market you're working in, oftentimes, you're looking at an exchange rate between whatever their investment is for a number of shares and whatever kind of capital they're putting in. I know for plenty of our teams, an issue comes about the spot rate, right? Especially if you're an early stage company, the length of the round can be quite long, and so spot rates that are agreed upon earlier in the round can, depending on what the currency is, kind of change. Are there kind of smart ways to approach kind of negotiating for that risk when you're putting together your term sheets and when you're putting together investor agreements? What are kind of ways, to an extent, like the fixed spot rate is the fixed spot rate, but are there ways to be thoughtful and pragmatic about that, or to anticipate kind of changes in the market?
Yeah, absolutely. First and foremost, I think get something into the agreement, or the draft terms that do stipulate against the fluctuating rate. You can look back and see historically how much a rate truly moves over the course of 3 months, or whatever you think that the negotiating period is going to be, and make it sensible. You don't need to say if it moves 15%, then we'll renegotiate. Even why you're putting that into the terms, to actually hedge and to mitigate the risk entirely. You're talking about effectively paying a premium for an option, and you don't really want to be spending money on something that hopefully will happen, but realistically may not. So I think it comes down to terminology and communication between the parties as to what is an acceptable move. And again, if they're an investor that's done this before, which you'd hope they are, they'll know there's an FX risk, and they'll know that one party's going to win and one party's going to lose. But you just need to be, try and bring it back to an even and level playing field.
Sure, makes sense. Cool. Well, unless I hear any other questions, I'll maybe turn it over to you for kind of your final thoughts on what startups, especially startups like those in the SOSV network, what are kind of the big takeaways that they just need to remember? That there might be people who weren't there for your initial slides. So what are kind of summarize the kind of main points that if you've learned nothing else from this webinar, what are the 3 things that you need to remember as you start working with FX markets?
Sure. Consider things ahead of the event. Definitely, if you can work even one step ahead, then you're going to know what you're in for, rather than trying to pick up the pieces if something goes wrong. Do shop around. It's a market for a reason, and there are certainly deals to be had, but there are certainly to be had by just spending a little bit of time doing so. And I think thirdly is probably also that it's a market as well. There are an awful people in, and everyone is offering something very similar, but what it comes down to more often than not is someone that you can work with, as opposed to someone that you just have to speak to service the transaction. So if you can find a broker that understands your business, or an FX expert, doesn't necessarily need to be a broker, that understands your business and understands what you have to achieve, you will save yourself an awful lot of time, and they will save you an awful lot of money and heartache throughout the process of managing your risk as a whole.
Brilliant. That's great. Okay. Well, thanks very much, Mark. Mark Palmer, everyone, from Hamilton Court FX. And certainly what I'll do is send along to our founders forum, for those of you on the mailing list. I'll send along Mark's contact details, and you can set up a consultation with him if you need to. And we'll certainly be passing along his slides as well. So you'll have all of this on record. So anyone, thanks very much, everyone, for joining for our first ever webinar. It's something new and exciting for us, and I hope you all found this very useful. Thanks very much.
Thanks.